Awesome. Thanks, Raleigh. Yeah, you mentioned CNBC. I actually I was at the I was at the Traders Expo this weekend. Got to see Morgan again, which was great. And I'm sitting there on Saturday, and I got an email from Jim Cramer saying, "Hey, is there anything you're watching for off the charts this week?" And didn't really have a lot, but then I sat there and kind of looked at the markets and realize that there is actually something out there involving VIX and interest rates. So if you tune into Mad Money tonight, I wrote up a extremely long off-the-chart segment involving kind of strength in the U.S. dollar versus interest rates versus the VIX, which I think you guys will find interesting. But that is different than what I'm about to discuss, which is the triple income wheel. So I'm going to share my screen. I'm assuming everybody can see it. All right, so riding the wheel, the option pit method. So today what we're going to learn is the structure of a covered call. Then we're going to discuss the structure of a cash secured put. Then I'm going to briefly talk about how time premium decays. I'm going to walk through the perfect covered call and the perfect cash secured put. I'm going to do the 5 secrets of a great covered call / secured. Going to show you how the triple income wheel works. All right, and really how to enter, manage, and exit. So, with that, what is a covered call? A covered call is a combination of a long stock position and a short call. The combination creates positions that can produce positive cash flow, increase an investor's margin for error, and help the investor make selling decisions. One of the issues I run into most commonly with stock investors is they fall in love with the stock and they don't know when to get out. All right, and one of the real advantages of using covered calls is it can kind of force that decision. So this is just this is an old example, but this is really no reason to change it because things don't, the structure doesn't change. So this is about, imagine back when Triple M was $97.20, all right? Covered call starts with a long position. In this case, I'll use Triple M. All right, you can see that is a long stock. For every dollar it goes up, it makes money. For every dollar it goes down, it loses money. All right, then when we sell a call, we get to collect time premium. We sell the call at $1.63, all right? Then when I combine them, all right, by owning the stock and selling a call, the combination creates a graph that looks like this. And notice that the break even is now $95.66. All right, so we really bumped up where we can make our money. So while you collect premium on the trade, it lowers our cost basis. But the upside is limited because if the stock moves above our call strike price, our stock will be called away. Sometimes I like to compare it to football. I'm a big sports analogy guy, so I'll compare it to kind of taking the points versus the money line. Money lines pay a lot more, but taking the play right. All right. So on our stock, our break even is now 95.66. But the most the stock call combo would make is $99.13. Above $99.13, the position no longer makes money. The lowdown. All right, what is the yield of the trade on a takeout? All right, so the stock price is $97.29. Strike price is $97.50. All right, you use whichever is the. If the strike price is above the stock price, you use the stock price typically. All right. If the strike price is below, then typically you'll use the stock price as well. All right. So the option price, and that's for a covered call trade. All right. The option price is $1.63. So the total return is the strike plus the option price minus the stock price over the stock price. So you make $1.84 or, a little more than 1.8%. All right. My minimum on these for both covered calls and on short puts, full margin is 1%. All right, when I'm doing these trades, I should be trying to get about 1% a month. All right, annualized. That's not always going to be the case, but certainly that's one of kind of the high water marks that I'll look at. There are stocks where volatility is low enough that I'll take less. All right. So management mechanics, and this is the part where I think people covered calls are pretty basic, right? A lot of people can figure this out. I was at my uncle Christmas. They were having a Thanksgiving birthday thing on Sunday, and my cousin is a pilot, and he was explaining to me that he's got all this stock in American, and that he and his dad, my uncle, were trading stock options around it. And I can tell you, the guy didn't know much about stock options, and he could figure out covered calls. So some keys to think about, though, is if you do not get the stock called away, then you cover the call and sell another expiration. All right, if you're getting any kind of real premium for the call, once they drop below a dime or a nickel, cover it. So if you pick up about 90% of the premium, that's fine. All right, options have this little card game effect where the last couple of pennies, the decay really, really slows down. So if you don't cover for 3 cents, you're actually giving up a lot more in the next month out than you're making in the front month. So when options get below, have covered about 90 to 95% of their premium, buy them back, all right, and then sell another expiration. Now, if the stock runs through the call, and this, I always tell people, let the stock get called away or unwind the whole trade, all right? Then wait a day or two, all right? That way you're taking the emotion out of it. So the nice thing is that you've got the advantage of, maybe you'll make a little bit of money on Monday with the market selling off, and, you get a free look at really, hopefully, something dropping over the weekend. You buy your stocks then. You want to do that covered call, whether you want to buy the stock and sell more calls. There may be other stocks that are better. This stock may just be garbage now, or you don't want to do it, or it's too expensive. There are all sorts of reasons not to engage. All right. So now what does this trade look like? This is a triple M trade. All right. Looks a lot like a covered call, doesn't it? It is not. This is a sale of cash secured puts, all right, in the December 5 weekly 157.5 puts, so expiring in about 11 days. All right. The cash secured put, and this is why it's always hilarious listening to like Merrill or some of these other ones. Oh, you can sell all the covered calls you want, but you can't sell cash secured puts. Makes no sense. All right. The cash secured put has almost all of the same characteristics as a covered call. All right. The main difference in terms of risk comes from assignment. All right. That's the main difference. All right. A covered call will only get called away when there is a dividend or an option is in the money at expiration. All right. And at expiration of the call has the stock taken away. All right. So you lose the stock. All right. You want to know a quick trick to figure out how to tell whether or not your option is going to be assigned to you if you're short a call? Look at the value of the put. All right. If the value of the put exceeds the net amount of dividends that will be received before that put expires, you are likely not going to be assigned. All right. So, an example. Let's just say Apple is going to have a $1 dividend, all right, and I'm looking at, and it goes ex-dividend tomorrow, all right? And I'm looking at the 110 calls I'm short, all right? If the 110 puts are trading 50 cents, more likely than not, you are going to be assigned. If the puts are trading $2, you probably will not be assigned. Now, one thing that can be confusing, let's say you are short a call that has 5 months expiration. All right? And so if Apple's about to have a dividend, how many dividends do I collect over that 5-month period? 2. All right? So I would collect $2. So if if I'm short, let's say 100 put, and it's worth $1.90, it is likely I'll still be assigned because the trader is going to get that $2. Now, it's obviously not cut and dry. There are reasons why someone would or wouldn't. But it's a very quick, back-of-the-envelope way of quickly figuring out whether you need to do something if you don't want your stock called away because of a dividend. My argument is generally give the dividend up, but but sometimes you're in a call spread or something like that, and there's very different risks with being assigned than just a simple covered call. So anyway, now that I'm off that rabbit hole, all right, a cash secured put will get put to the trader when an option is in the money at expiration, or an option becomes extremely in the money prior to expiration. All right, this is related to cost of carry. All right, this is not something you're going to have to worry too much about. All right, and the seller of a put has stock given to them, otherwise known as put to them. All right, as opposed to losing the stock. So that is the big difference. So the real differences between a short put and a long stock short call is simply how the assignment is treated almost all the time. Hard to borrow is about the only other thing, but I'm not digging into hard to borrows right now. All right, the lowdown is the trader is hoping to sell a put, sell put after put without being assigned. This builds up large amounts of yield before taking delivery. In the triple M puts, I'm selling an option with 11 days to expire, collecting about 46 cents. If I'm never put to and can collect 46 cents every 11 days, over the year I'd collect about, $15.26, or about a 10% yield. Not great. One of the things about December expirations is they always have lower volatility, so it makes them less than great. Now, the other piece to recognize is that with short puts, when you're calculating the yield, use the strike price. Okay? So that's where the yield comes from. All right, management mechanics. The major difference in mechanics is that a cash secured put should be sold slightly out of the money instead of slightly in the money like a call. Well, slightly out of the money like a call. All right? That's a typo there. So it should be slightly out of the money below the stock as opposed to slightly out of the money above the stock. That's what I meant to write. All right? So with triple M trading 160, I'll sell a 159 put, a 58, a 57.5 put. With a trade in 160, I'll sell a 61 call, a 62 call, or 63 call. All right? You sell calls above, you sell puts below. All right? If the delivery gets put to you, be willing to accept delivery. All right? Be prepared for a wheel trade, which we'll discuss in a bit. All right? Don't sell cash secured puts unless you really understand, unless you're ready to do this wheel trade I'm going to cover. All right? If the put can be bought back for less than a nickel, like I said with the calls, buy it back and sell another. All right? You are giving up being greedy and saying, I don't want to pay, name that broker, X number of commission to buy this put back for a nickel. All right. By doing that, you are giving far more premium than you're paying in commission, because that nickel to zero price can be incredibly stubborn. Incredibly stubborn. All right. And the reason being is, if I'm a market maker, right, why do I want to sell you a nickel option? What is the value in it for me? Right? Why would I want to sell you an option at a penny? Right? So I'm going to take my sweet time decaying those down. All right. Premium selling. All right. This is a chart of option premium time decay at the money. All right. As you move away from at the money, decay becomes much more linear. All right. But in terms of near and at the money, so call it between the 40 deltas. So a put that is 1 to 2 strikes out of the money and a call that is 1 to 2 strikes out of the money. This is pretty much what decay looks like. All right. It gets exponentially higher. So at 30 days to expiration, at the money options see a dramatic increase in time decay. In the final week, the call or put still has a huge portion of decay to lose. All right. New traders need to think hard about the duration of the call they sell. All right. As they become better traders, you're going to want to adjust that duration. All right. So between now and Feb expiration, there are 4 weekly contracts. This is in Facebook. This was in January of this year. All right, not counting regular Jan. All right, Facebook is trading a little over $73. All right, would I rather sell the weekly 74 calls 4 times or the regular Feb? I should say Feb, folks. I hate typos. Feb calls just once. All right, let's take a look at the option montage. So here we go. All right. Oh, this was AugSep. I'm sorry. So this is more recent. I just had some typos in there. So here we are. It's Aug8 versus Sep 5. So Aug8, I get 73 cents. All right, or 74 cents. So if I multiply that times 4, I get $2.96. Now, if I just sell the Sep 5s, I'll get between 240 and 245. The weeklies give us more flexibility, and if traded right, we can collect more premium, especially at the money. All right, does everyone understand how I got to that? If not, I'll be glad to cover it later. All right, so here's February. All right, you see, so 74, if I just do it for a week, all right, if I did these 74, then collected 74, then collected 74, then collected 74, and then collected 74 here, I get $2.96. All right, if I just do the Sep 5 74s, I collect $2.40. So I collect more premium. All right. So this is just a simple example of kind of how one can walk through a covered call trade. Should have been up at a different spot. I'm sorry, this is out of order. So the person who looked this over clearly did something wrong. All right. So now let's talk about duration psychology. All right. Much like a football coach, you need to know how good your quarterbacking skills are. All right. If you are Peyton Manning, this weekly approach can make sense. All right. If you are Bradley Manning, the monthly approach might make more sense. And for those of you who are saying, who's Bradley Manning? He was the lead singer of Sublime. All right. So the question is, know who you are. Don't try and be a hero, especially at first. All right. So when you're first learning, selling puts and selling calls, against stock or around stock. All right? Start with the monthlies. All right? As you get better and you want to ramp up that premium, all right, just like every other spread, all right, then start using weeklies. All right, so now let's talk about the perfect covered call. All right, in a perfect world, the underlying would creep higher every month, but would not skyrocket higher. The trader would be able to consistently sell calls at higher and higher and higher strike prices, building up yield. The stock is never called away, or better yet, is called away at the absolute top. And the stock pays a dividend, further increasing that yield. Now the perfect cash secured put. Again, the underlying would creep lower. All right, this is just cash secured put, but would not tank. The trader is able to consistently sell puts at lower and lower strike prices for similar premium. All right, building that yield. All right, the stock is never put to, and the stock pays a dividend, which doesn't really increase yield. That's wrong. I'm deleting that in case somebody gets this. But it does decrease volatility, which is one of the reasons why I'm always looking for dividends. All right, so how to sell puts and calls. All right, there's some smart things that can be done to manage the sale of calls and puts. Now, what we've just done is describe the what. All right, and with some little tips in here. All right, a lot of guys will give you the what. All right, it's not hard to find on the internet. There are not a lot of people that want to give you the how, and that's what I'm here to give you. All right. There are some smart things that can be done to manage the sale of calls and puts. Many involve volatility of the stock and simple decision-making from the trader. All right, so now let's start with the type of stock. All right, what type of stock creeps higher or creeps lower? All right, Amazon or Microsoft? Very simple. It's Microsoft. Amazon, what a jerk stock. I mean, seriously. So they have abysmal earnings, tanked to 290. And then a couple of weeks later, on no news, the stock is trading higher than it was before earnings by a full $10. That is just silliness. All right? That's why I'm not a stock analyst. I'd go balder much faster than I'm going to at my current pace. All right? A trader that sells puts or cover calls on a high volatility stock is constantly presented with, do I cover? You know, do I buy the call? Do I buy the put back or not? All right, happens consistently. It's a massive pain in the butt. All right. Whereas if I do Microsoft, because it moves in small clips, I don't have that same problem. It's got a lower volatility. All right. Now dividends, stocks that pay dividends have a lower volatility. It's almost always the case. All right. They also will have a nice dividend yield that, combined with the yield from selling covered calls, can produce a nice income stream. Dividends can soften the blow of being put to in a cash secured put. All right? And will typically creep higher with increases in dividends. So that's a nice thing. Stocks that have big dividends, all right, will typically, I mean, probably the wildest move I've seen in a stock that has a decent dividend in the last year or two has been some of these oil stocks like Halliburton or IBM. And that's about it. I mean, that oil move has just been unbelievable. All right, so, you know, having a dividend doesn't mean there won't be volatility. Oil's more of a structural thing. But having a dividend, most stocks that have dividends, if they sell off, they rally. People like that yield. All right. All right. And now the strike. I like to sell a covered call at a strike that produces a net price, all right, that I would sell the stock at today. If I buy GE for $20.15 and I sell a 21 call at 15, all right, at 30 days to expiration, that's a 4.9% takeout yield. All right. Am I happy with the return the stock gets called away? Do I collect the dividend? All right? And then I like to sell a call that I don't mind having the stock called away. All right? Surprisingly, you will find this is often the at-the-money strike or the next out-of-the-money strike. All right? I like to sell a cash-secured put at the level that I would own the stock. All right, so if I sell a put in GE at the 26.5 put at a quarter, and I have the stock put to me, I'm buying GE for about a 3% discount. All right, again, I'll find that that's usually an at-the-money put. I should say put. I'm sorry about the typos, folks. They don't bring me in here for my grammar skills, folks. All right. If this was the English sprint, I would have all sorts of problems here. All right. I'd be getting eviscerated by Mrs. Heslaw, my 5th grade teacher who made us diagram. Again, you know, a lot of times that at the money or the next one out of the money will be the put that you want to sell. So really, the last 3 sides are to prove 1 point. All right, it is not the premium that matters. It is the overall volatility of the stock, that realized volatility. All right, how much does the stock move? Trade covered calls and cash secured puts in low volatility, low beta stocks. You collect less premium, but over time, you will likely make a lot more money. All right. You know what I like to buy? You know what I like to do in stocks that have high betas and high volatility? I like to do spreads. I like to buy options. I like to do, you know, ratios. You name it. All right. But I do not like to do trades that can have the stock put to me or have stock taken away in high volatile stocks. All right, so now let's talk the 5 secrets of trading these options. All right, now the first rule of trading: if anybody tells you that something's a secret, it's not a secret. All right, you want to know what's a secret? The trade that they're not telling you about. All right, so there are no secrets, but what there are smart ways to put the odds in your favor and not smart ways to put the odds in your face. All right? There are no secrets. Only trade in stocks you are confident won't go down. All right? Notice I didn't say stocks that will go up. All right? There is a big difference. All right? So stocks that rally fall. Stocks that don't drop might not rally as hard, but they slowly creep higher. All right? So stocks that don't drop, if you get the stock put to you, it will creep higher, making it a great, you know, making it more likely to collect the dividend, and then we're going to get into the wheel, and you'll understand why. Secret 2. All right? Find stocks that are lower volatility. All right, stocks that have a lower volatility will pay a smaller premium, but will likely not fall below your break-even point. All right, so in M, when I showed that example of 95.66 being my break-even, even if M had fallen below my strike price of 97.5, it was a lot less likely it was going to fall below my break-even point. All right, that's typically if I'm above my break-even point, and you know, rather than have the stock put to me, I'll unwind the trade. All right, if it does, it will only do so by a small margin, and another sale can, you know, a call sale or, you know, some type of sale can typically move the break-even. All right, secret 3: buy stocks with a nice dividend stream. Stocks that have consistently seen an increase in the dividend have lower volatilities. If one is assigned on a put or a short covered call, collecting the dividend yield or is short a covered call, collecting the dividend adds to yield. Secret 4, only trade in stocks that you want to own. All right? If you know, and you understand. All right? So I don't really follow the healthcare stocks at all. All right? Or biotech. One, you shouldn't be doing these in biotechs, but let's say like United Healthcare or Cardinal Health. All right? Even if a cash secured put or a covered call looks good, that doesn't mean you should do it. All right? So even if a option looks, if you don't know what you're trading, don't do it. So I want to own stocks that I understand. All right? And so I'm not trading Cardinal Health. All right? Trading things like Exelon or, you know, a few things like that. Secret 5. All right? If premium is too cheap, you have to be willing to say there is no option I want to sell right now. It almost never makes sense to sell options at 15 cents or less, no matter the price of the stock, with rare exception. And I'm going to show you a stock where I did do ones below that. All right? And it almost always makes sense to buy your put or call back below a nickel. All right? So watch those premium levels. All right? When premium is too cheap, at a minimum, you don't want to sell it. At a maximum, you might want to own it. All right, so now let's talk the triple income wheel. All right, the best way to use calls and puts in tandem is a trade called the wheel. All right, in the wheel, the trader is using 3 sources to produce income, and this is how you guys, how I would instruct any of you to approach using options and stock together. The first rotation of the wheel is to start selling puts. All right, follow the secrets to selecting a put to sell. All right, so you sell a put that's slightly out of the money over and over and over again. I did this earlier in the year in Facebook and did great. I did this in Oracle. I'm going to walk through that example. And then so you just sell that put over and over and over again. And you keep selling that put to build up yield. All right, and as the stock hopefully falls, all right, you are selling the put at lower and lower and lower and lower strikes. And this is a stock that you want to own. All right, then hopefully the stock gets put to you at the bottom. All right, now on the flip side, if the stock does rally, one should have a strike price that they are not willing to sell puts above. You know, I love Facebook if I can get it for below 75 bucks. All right. Well, if I can only get 70 cents in selling the 75 put, that means I would be buying Facebook for 75.30. All right. That is not a good sale. All right. Now, keep track of all the sales that you have, because that's your kind of net break even. But for the purposes of buying the stock, just look at the individual put. Source 2, the dividend. All right. Once the stock is put to the trader is able to collect the dividend. All right. So this is great. So I sold, 5 puts at $1 a piece, collecting $5 in Facebook. All right. So my net price is $68. All right. Let's say, well, Facebook doesn't have a dividend. So in Softy, all right, I sold 5 puts at 50 cents, and then the stock got put to me, and so my net price is, $46. All right. Well, then at $46, I get to collect this dividend. All right. Now I'm 36. All right. So whenever I own stocks that pay a dividend, I always put them on a DRIP, dividend reinvestment program. All right. Your broker can do that for you. The value of a DRIP is that there's almost no commission in buying stocks with that dividend. So if I own 100 shares of Microsoft and it pays a 25-cent dividend, I'm getting 250 bucks. All right, well, that'll buy 5.3 shares of Microsoft. All right, that you pay almost no commission on. All right, so the nice thing is then, if and when, then if I ever lose my initial shares I was assigned on, which I'm going to discuss in a minute, I get to keep that 5 shares, and I leave those on a DRIP, and I can actually build a lot of wealth doing this. All right, older people and employees of the actual company should always take the income from the dividend and invest in the overall market. All right. In fact, I would highly recommend against selling puts in a company that you work for. All right. And I'll give you some examples on why. All right. Take a look at the long-term chart of Yahoo. Take a look at a long-term chart of Enron. All right. There are all sorts of companies, all right, where those long-term charts tank. And you say, well, Mark, so what? Well, what you're really doing when you buy a lot of extra company stock beyond what is kind of incentivized to you is you are doubling down on your income. So if I worked for Enron and my entire wealth was in Enron stock and I was selling puts in Enron, all right, how do you think I'm doing today? If I'm not in jail, I'm probably happy, right? But, the greater point is that it's smart to diversify, all right? All right, now, source 3, sell calls. So I've collected puts, collected all this income. Then I've hopefully gotten the dividend. And now, so I collect puts, or I sell puts, I take delivery. I now own the stock. As soon as I own the stock, I start selling calls in a covered call trade. So the call should be sold at a strike the trader was put to or higher generally, all right? Now, if I have tons and tons of premium that I collected from selling all those puts, well, then I don't really care, all right? So recall that even if the trader buys and sells the stock at the same strike, he or she will collect all of that triple income, right? So if I sell a put in Halliburton at the 50 strike, and I take delivery, and then I sell a call at the 50 strike, and it gets called away in 2 successive weeks, well, I kept all that income, and I really never held the stock. All right? So that is the wheel. So it's sell put, take delivery, collect dividend, sell call, over and over and over again. All right? So here's some tips to executing this trade. All right? Once a full rotation of the wheel happens, wait a day or 2 before selling puts again. Examine to see if there are better put sales. All right? Like a long position, if the trader owns the stock, he or she still needs to have a max loss on the position. All right? So I can tell you horror stories of people who were put seller in Shield, Sears Holding Corp. Ask me how those people are doing. All right? And if an assumption changes, stop doing the wheel. All right? IBM used to be a great wheel candidate, right? Just sat there and grinded higher and paid a dividend and yada, yada, yada. All right? But would I do that in IBM now? No, the dividend might drop. Nobody knows where the revenue might go. There's all sorts of reasons not to. All right? So here's an example that I did for TheStreet.com a couple months ago in Oracle. All right, I do some writing for The Street as well. So on September 19th, I sell the September 26.39 put. This was right after earnings, after Oracle got slammed. I sell the put at 22 cents. All right, the stock was put to me. All right, on September 29th, I sold the 39 call at 13 cents. On October, and I'm doing weeklies. With weeklies, you can get away with doing a little bit less. All right. On the 6th, I sold the 39.5 calls at 13. On the 13th, I sold the 39 calls at a quarter. On the 20th, I sold the 39 calls at a quarter, and I got the stock called away. All right. And on top of that, I collected a 12-cent dividend. So in 5 weeks, I collected $1.09 of income. All right. That's $1.09 of yield over 39 bucks, or about 2.7%. Annualized, that's a 30% return in that stock. All right. Oracle is a great wheel candidate. I really do like that one. All right. So in summary, high flyers aren't for premium sellers. Sell calls. Turtle stocks are perfect for covered calls. Learn the secrets and trade the wheels. So now, what is my offer? Well, I've got, the last time I was here, I had a boot camp. I got another boot camp for you guys. Begins December 9th. All right. It is a 4-day boot camp. All right. It's going to be December 9th, 10th, 11th, and the 13th. So there's Tuesday, Wednesday, Thursday, nothing Friday, then Saturday the 13th. All right. Each class is about an hour and a half to 2 hours. And we're going to cover understanding how volatility can improve entry and exits. We're going to increase profitability for directional trades. We're going to manage trades to reduce risk. You're going to learn the power of delta neutral trading. So you're going to learn all sorts of stuff: directional trading, delta neutral trading, risk management, all right, and entry and exit points. All right. Now, the week after it's over, I'm going to give everybody that takes it 1 week of my trading room for free. And because I always give my absolute best deal to Trading Pub people, if you use the code 24trade, it'll take $50 off the price. So we're talking $97 which is just disgustingly cheap. All right. So normally I would charge like $400. We're selling it at $147, which is a deal. And because you guys are involved with the Trading Pub, I'm going to take an extra $50 off. You go to optionpit.com/bootcamp to sign up. All right. In addition, it helps the Trading Pub as well. So I will now take questions. Yeah, no, Facebook is not exactly a low vol, low beta stock, but that was one I was trying to own. How do you protect against the stock that was put to you? Well, one way to do it instead of just selling a put is to buy something really cheap, far out of the money, and do like a cash secured put spread. So here, the advantage of that is actually twofold. So let's say with Oracle, let's Oracle. All right, Oracle, I sell the 39 put at 25 cents. Well, then if I buy the 35 put for a penny, I'm going to reduce my margin by $35, and I'm going to put in a floor below 35 bucks. So that is usually the way I do it. That is a smart way to do it. The other way is, once it's put to you, is just have a stop loss, and or you can do another cheapy little put, kind of a cheapy collar. Are there any additional questions? Keep them coming. Can you explain why you would buy the put call back for a nickel instead of letting them expire to keep all of your premium? Well, the point is that if one really, I'm going to use the whiteboard. All right, everybody look at the whiteboard here. Do I have the ability to draw on this? How do I draw on this? There we go. So Remember I showed this graph of time premium that looks like that? Well, in actuality, the graph actually looks a lot more like this. Theoretically, that's what it should look like, but the graph actually looks a lot more like this. All right, this being about a nickel. All right, and the reason being is because traders don't like selling super cheap, super cheap options. So they decay much slower than many people realize. And so in waiting for that option to decay, you're probably giving up more premium out of your next sale than you are making in trying to harvest all of that premium. Does that make sense? What percent of my option trading funds should be put in the wheel? I would actually say that the wheel trade is more of a stock trading replacement system than your option trading funds, if that makes sense. So I use for somebody with a big portfolio, if they really want to go to cash and then start trading this, I would use this as a replacement for the stock portion of my portfolio. What is the minimum account size needed? It depends on the stocks you're using. If you have a smaller account, one should use that kind of put spread selling approach that I laid out. But the minimum size is going to be basically 100 times the value of the stock. So, all right, it costs $9.95 in commission to buy back a nickel option. Well, if it costs you $9.95 in commission to buy back a nickel option, you're paying too much in commission. What is my favorite strategy? I use a lot of ratio spreads and 1x2s in my personal trading. How can you adjust a bull spread if it dips in the money? Mark, ROI on a put spread is usually higher than ROI on a naked put, all other factors being equal. That is true, but that trading put spreads like that is a little more complex. So how do you get cheaper commissions tossed as pricey? Well, I have my ways. My students actually get discounted prices at LiveVol, Thinkorswim, Options Express, you name it. Because one of the things I do not accept, I've got a couple that will advertise with me officially, but I don't accept referral payments for sending students to different places. Which broker do I prefer? Well, if you're international, Interactive Brokers is really your best option. You're going to have to explain is how can I adjust a bull spread if it dips in the money a little more. Yeah, there are brokers that allow you to buy back a nickel put for no commission. There are. Indeed. All right, now that 24 trade discount is only good until through Saturday. All right, and then I'm killing it. Well, Thinkorswim, Trade Monster is just kind of generally cheap. Yeah, that's not going to happen in Canada. In Canada, your cheapest trade is going to be Interactive Brokers as opposed to TD. Will you be able to review the course? Yes, everybody gets to keep a recording. You know, I don't really deal with the TradeStation. My two primary brokers are Live Vol Execution and Thinkorswim. I also have a small account at Trade Monster, and I play around with Option Express every now and again. So yeah, everybody gets to keep a recording of the course as well. What covered call have I got going right now? We're actually in, for the street, I'm still doing, I'm actually doing the Oracle trade, the short put trade right now. And quite honestly, the big trade I've got in my personal account is a position in UVXY, which is short, and then you know, I've got a couple of small things here and there. But I'm a little bit more of a trader than I am an investor, to be fair. All right. Do we have any other questions? All right. Well, I think that was easy. All right. Well, does anybody have any questions on anything else? I've got some time. Ask away. Are we going to watch my segment on Mad Money tonight? What are the dates again for the boot camp? It's December 9th, 10th, 11th, and the 13th. I think the next major market to go up, and this is actually going to be my point tonight, is that I think that mid-tier housing is underpriced. So I like KBH. I like Pulte, some of the other names like that. Because, you know, to be honest, the Fed is not going to raise rates in 2015. So that's the sector that I'm looking at right now. Utilities I loved, and I'm loving them a little bit less now. They're pretty fully priced. Are you bullish or bearish to short-term VIX? I think VIX is going to be falling some more. I think VIX is likely to get back down to 10 before it really turns around. I do think, yeah, XHB, or what's the other one? XLB, that's the other one, I believe. But yeah, I like XHB a lot, and the volatility's low. So a trade that I wrote up actually last week for the street was to buy the March 34 calls, and those are doing pretty nice. Let me look right now in XHB, and let me tell you a trade I would like in XHB. Give me a moment here. Volatility analytics. Ho! So how many people got my Bradley Manning reference without me having to say Bradley Manning? What happens if a stock drops through 7? All right, good. That's nothing sad about that. You should be excited. You should be excited. What happens if the stock drops through 7 for 1 and you have a put bull spread on? Oh, so if the stock does a 7 for 1 split, you end up with 7 options actually, and your gamma explodes, and the underlying is going to rally. And the underlying is probably going to pop. All right, so I mean that was Apple that did that. That was nasty. All right, so let me take a look here. You've got implied vol at a. Let me take a look. Implied vol in XHB is at a 2-year low. All right, which is cheap, right? Everyone understand that. All right, that is cheap. And then the stock is doing all right, but it's not, you know, stock's trading what, 33.46. So I would look at, let's say, like the March. I mean, the March 34 calls for $1.10. I mean, I like that as a trade, as a long-term trade. I mean, that would be one that I would be looking at. What's my short-term outlook on gold? I think the dollar is going to keep getting stronger. As soon as that Swiss election as soon as that Swiss referendum does not pass, gold is going to go right back lower. All right. I'm looking for a high of 2130, 2155. What do you think market reverses just like 2008? Well, with 2008, I'm going to be watching the VIX because the one thing to remember is 2007. All right, the VIX, even though the S&P was slightly higher in the year, the VIX actually ended up higher than it started. And we've not seen this kind of slow ramp up in volatility. So I think there's another, I think there's another leg up here, and it's going to be interest rate driven when we realize that Janet Yellen has no reason to raise rates. In fact, the only people who haven't figured that out is equity traders. Do you think if Janet Yellen was going to raise rates in May, the 10-year note would be trading 2.29 with a yield of 2.29? Absolutely not. I mean, I think we're going to rally right through the end of the year. Then you maybe get a little dip mid-January. Are ETFs better for this strategy? I think if one takes a lot of time doing research, you're going to have a lot more success with stocks than ETFs. If one doesn't really have the time to pick their spots, then ETFs are better. How high do I think Apple will go? Well, who knows is my answer. I think it's probably high enough. I don't know that I would be buying it here. Let's just put it that way. Bradley on the base, Raleigh. All right. Any other questions? I'm happy to field anything. They pulled. How do you trade vol skews? Oh, there's a good question. The key is understanding where is at the money volatility and where is skew relative to to kind of where volatility is. One of the keys to skew is when you recognize it as steep, you should be buying at the money options and selling the skew. And when one recognizes it as extremely flat, one should be buying the curve and selling at the money. So on a low vol flat skew, I'm looking to do back spreads. So you should not be seeing anything other than a green screen, I don't think. When skew gets really steep, I'll start doing broken wing butterflies or 1x2 front spreads. How often do bid-ask quoted? Morning only seems like the quotes stay flat. They're quoted constantly. Basically with every tick, traders are setting new quotes. All right. Let me see if I can, and give me a minute. I'll see if I can find something interesting that I like as a trade today. Oh, you know what trade I like? Take a look at MasterCard. Let me see if that's still hitting those new lows. Ooh, Palo Alto Networks is up $6, and they're just crushing the implied volatility. That's an interesting one. Not coal. So take a look at Palo Alto. This is one we were kind of playing around with yesterday. I'm looking
Mark,
at that implied
Raleigh
volatility.
I just want to let you,
yeah.
I'm cutting in for a minute because all I see really is a gray screen with a pink hand moving around on it. Okay, there we go.
Oh,
see something
sorry.
starting to load here.
Let me share. Application. Here, I'll just share my monitor. I don't really play earnings typically. Did I lose application? What's going on here? Come on.
Yeah, because what I see is your slide being projected here.
Wow.
A couple other questions have come up here, Mark. Michael's saying, what's your target for SPY for the end of the year?
Come on. All right, now let's do start text sharing.
So it seems like we have had a few little technical issues. Well, let's do this here, folks, because once again, this is nerve-wracking when this happens to you, and I know it puts added pressure on a presenter when you have some technical issues, but I want to thank Mark for that very insightful presentation on how he trades puts and covered calls in sequence for income generation. I found this concept around the wheel where you're selling puts and investing dividends and then selling calls to be extremely intriguing and something worth pursuing. And I also want to thank Mark for that special offer that he created for our members, which is a 4-day boot camp. And that will kick off on the 9th of December. So it's the 9th, 10th, 11th, and 12th. And that will be 8 hours of online training. Plus, he's got an extra bonus week of 1 week access to his live trading room. And normally that's over $400. He's priced it at $147. But for the trading pub members, if you sign up by Thanksgiving, using the special promotion code that Yana has put out there, it's only $97. So I think from that perspective, it sounds like a wonderful opportunity to get some real one-on-one exposure to Mark and the way he likes to trade the markets and the way he thinks the things are set up. And that's right after Thanksgiving. It's that first, I guess that second week in December, from December 9th. 10th, 11th, and 12th. Maybe a good way to learn something new that you can sink your teeth into as you, prepare maybe for some new trading ideas in 2015. So once again, want to really thank Mark for his time preparing the presentation and delivering it today. And I apologize that there's been some technical issues, but we've all been there before, and we slugged through it just fine. And so once again, Mark, thank you so much for your time, and I hope you and your family have a very, very happy Thanksgiving holiday. I also want to remind everyone that today's sessions are being recorded, and we will send everyone that registered a link to these recordings no later than tomorrow afternoon. So if you happen to come in a little bit late, or you have to leave a little bit early and there's a speaker you really want to hear, no worries whatsoever. We have 3 presenters today, and every one of their presentations will be rendered and edited, and we'll send out a follow-up email with these presentations no later than tomorrow afternoon.